You know, talk energy. Welcome back to the program. There we go. Joining me in the studio, Mutton Crab from Shaw and Partners, Rudy Philip Van Dyke from FN Arena, and of course we're going to talk gold in a bit more detail. Commodities have been a big focus of late, and precious metals as well. But one of the businesses we're watching today is Perseus. It's up 10%, record gold production levels for Perseus Mining in the June quarter. The gold miner posting a massive 31% jump on the previous period, and flagging the record figures were driven by its transformation to a West African focus. Joining us now, though, to discuss in more detail his company's showing, Jeff Quartermaine, Managing Director and Chief Executive of Perseus, joins us out of our Perth studio. Jeff, great to have your company on the program. Thank you for joining us. You've obviously had record production predominantly because you've sort of transformed from this single to multi-mine business. How are those two mines tracking?
Look, both of those mines are going extremely well at the present time. We're very, very happy with both. The Edikan mine's been around for some time, and we've been progressively improving that over a number of successive quarters. The second mine, the Sissingué mine in Côte d'Ivoire, we brought it on stream earlier this year, and it's been performing extremely well ever since we started up, and we couldn't be happier with the way that that's working at the moment.
And obviously this is helping you with the next phase of your business, which I know you're planning on developing another mine this year. What's the timeline on that, and are you all set, I guess, for that to start?
Yes, no, we have a third mine lined up to go to development later in the year, towards the end of the year, and the performance from the two mines in this quarter and in previous quarters is very important in that context, because we're generating a lot of cash from the business, as we'll report next week when we put our quarterly report out, and that cash will be deployed to fund, partially fund the development of our third mine.
Using cash and a mix of debt?
That's correct, yes. We have a good cash balance at the moment. We're generating quite a lot of cash on a month-by-month basis, and we have been engaging with potential lenders, and we're very comfortable with the prospects of bringing that debt to bear later in the year.
In terms of cost guidance, just give me a view on this going forward, given the fact that you'll have, a total of, I guess, 3 mines now this year in production.
Well, look, I can't speak in very specific terms, given that we have our quarterly report due out next week. But but certainly, as we bring the 3 mines in, we'll be producing around the $800 to $850 per ounce level US, out of the 3 properties. But in the immediate term, we're going to be seeing significant improvements in our cost profile. The Sissingué mine is a very low-cost mine, which offsets a slightly higher cost situation at Edikan. So between the two, I think the market will be quite pleased with our cost performance when we announce it next week.
You're West Africa focused, and obviously that comes with some geographical challenges. What are the main challenges you see of operating there, and how do you mitigate the risk for shareholders? Well,
look, I'm not sure that the risks are all that high relative to anywhere in the world, to be frank, but certainly people are a little nervous around it. I guess it's a little of the fear of the unknown. For us, we're not so concerned, but one of the very key things that we do have to do is to ensure that we're welcome in the countries that we operate, and to that end we pay a great deal of attention to our relationships both at a community level and at a government level. So certainly focusing on making sure that people get a fair return from our investment is a very important part of what we do.
Obviously, we're looking at a lot of tensions across the globe at the moment, including trade wars and trade tensions there. And you'd imagine that would spark a bit of a rally on the gold price, although it hasn't really rallied as much as you would imagine it as a sort of safe haven status metal. Why do you think this is?
Look, it's a very good question, and I don't have an answer to that. I mean, one of the things that we have observed is that many of the traditional linkages that used to drive markets seem to have altered in recent times. But certainly from what we're reading at the moment, there's certainly a case to be made that global instability in the financial sector will have an impact on gold going forward. And we would certainly be in a very good position to be a beneficiary of that if it does indeed occur.
You don't think it's lost its sort of safe haven status?
I don't think so at all. I mean, it depends on who you speak to as to what the views are. Certainly, we have a lot of investors in Europe and in Switzerland, and they certainly wouldn't share that opinion.
How, I guess, do you deal with the volatility in the price of gold? I mean, there are so many factors that play in to the way gold trades. Macro Fed, US interest rates, currency moves, global tensions. How do you deal with this as a business and sort of try to bring some consistency?
Look, to be frank, we've got no control over that situation at all, other than we can employ a hedging policy to a degree. Now, what we do at Perseus is that we hedge about 30% of our production on a rolling 18-month basis, and so when we're in a position to do it, we sell our gold forward and we lock in higher prices. So where we sit at the present time, we've got about 150,000 ounces sold forward and at a weighted average price of about $13, $15 an ounce. So given where the gold price is today, that hedge book's worth about $10 million to us. Now, we tend not to look too much at the gold price. What we really focus in is getting our costs down, because we believe that if our costs are low enough, then we'll survive in almost any circumstances.
Well, we'll await those numbers next week. Finally, over the next sort of couple of years, I guess, the sort of medium term, what's your main focus? Obviously, you've got this third mine opening. Are you wanting to open more mines going forward if that one is successful?
Yeah, very much so. I mean, the third mine will convert us into producing around 500,000 ounces of gold a year. But ideally, what we would like to do is to have a portfolio of 4 or 5 operations in order to be able to spread the risk that comes with mining and comes with mining in West Africa. So that's certainly our longer term vision. But right now we've got a big job on our hand to keep the very good performance that we've delivered in recent quarters going, and to bring into development our third mine later this year.
All right, Jeff Quartermaine, really appreciate your time on the program. Thank you for joining us today.
Thank you very much indeed.
Perseus up 10% today in trade. A solid performance for the stock, 47.75 cents for that one. I guess I want to bring in my guest host on gold, because it is such an interesting space, and gold stocks were rallying yesterday for one, Martin, but it's a tough space to trade in. Aussie dollar gold's done particularly well because of currency moves, but is this a space that you have exposure to, and what are some of your favourites, Martin, in this?
Yeah, no, it's an interesting one, isn't it? Like the question you asked, Jeff, was around, there's the Fed, there's interest rates, there's inflation, there's geopolitical risk. There's all these other factors. They've got the central banks and what they're doing with their gold, and so there's so many different moving parts. But we're kind of trying to simplify things a little bit. You want to hold gold if you think inflation's going to start accelerating, because it's just a store of value, right? So it's a hedge against inflation. So we suggest that that's still the biggest risk, longer term risk to investors, is an acceleration in inflation. So the last 5 or 6 years has been all about deflation. We think that turns around. So things like tariffs, they're inflationary, higher interest rates, etc., etc. So we want to hold gold in the portfolio. The question is how much. If you're running an alternatives portfolio, you might have up to 15 to 20% of your portfolio in commodities and a lot of that in gold. In an equity portfolio, we reckon around 5% is about the right number for gold, and then it comes down to, okay, what exposure do you want? Do you want an emerging producer like a Perseus that's got a bit more risk? Do you want a marginal producer like St Barbara or something that runs when the gold price runs? Or do you just go for a blue chip one like Newcrest, which has 26-year mine life and all that sort of stuff? So we go the latter. So we say we want the highest quality, what we think is the highest quality producer, best assets, longest life, lowest costs, etc. So we just own Newcrest. And I think it's about 4 or 5% of our portfolio.
Okay, Rudy, what do you think?
Well, I agree. There's lots of factors impacting on gold, and most people, the real gold bugs, they pay attention to any of them. They only watch one thing, and that's certainty or insecurity. Yeah. I'm not a big fan of gold in this part of the cycle. The reason is very simple. Historically, the biggest mover for gold is US bond yields. And that's the reason why gold hasn't performed so well in recent times. And the other factor that you always have to pay attention to is the US dollar. And then not always, but often they move in tandem. That's the reason why gold isn't performing. You either have the bond market not cooperating, or you have the dollar not cooperating. So there's much more to it than... I'm not a strong believer in this part of the cycle, in the inflation story, because if inflation moves up and the bond yields also move up in the US, then gold is still not performing. So you have to look in the broader context. And at this point in time, the short-term yields in the US are moving upwards. They are going to a net positive, basically, and that's basically keeping gold back. So unless those dynamics change, I have zero exposure to gold.
Zero exposure? You don't even think there's a place for it in your portfolio?
Well, I just explained to you why not, but I have that triangle in my view.
I mean, I hear your explanations, but your explanations could also warrant a very small exposure to gold.
They could, yes, it could. But see, for me, if I don't see a clear reason why I should have gold, then I don't have any gold. because gold in itself is actually quite a small market, and it can move. It's almost like a small cap stock in the share market. Yeah? It can move if things turn out badly and positively.
All right, we're going to take a break. When we return, Justin Smirk from Westpac with his take on the economic week that was and what's in store next.